Everyone, welcome to JEDi episode 17. My name is Jimmy, and with me today are Ethan, David, and our special guest, Jing. For those of you who tune in to our Facebook Live for the first time, and if you want to know more about us and the name JEDi, do check out our first episode in the video section. I'll be the moderator for this episode, so here's how we'll run through. Firstly, Ethan and David will be having a fireside chat on investments part 6. Then Jing will be sharing a bonus section on investment mindset. Then last but not least, we'll have a Q&A section. So feel free to post your questions in the comment section and we will address them later during the Q&A section. So without further ado, I'll let Ethan and David start the ball rolling. Ethan? David?
Okay, hi everyone. I'm Ethan, the founder of PolicyWoke. So today we'll be talking about two quite important concepts. One is the value investing. The other is growth investing, and how do we actually make sense of both? Okay, so first off, what is actually value investing? So in order to look at this, we have to break apart the two words. One, what is value? So what do you consider value by? So normally, the most straightforward is to understand it as price lower than the asset value. Meaning to say that if my value of maybe this water bottle is 20 cents, I got it at 10 cents, definitely is a bargain because I can resell it at 20 cents if that's the case. So that is something that we look in terms of being relatable to what is called value. And investing is, as what we have mentioned earlier on in our previous effort, is just to put in resources for a future benefit. So in this case, it's like you buy a chicken and you're waiting for it to lay eggs every day. Yeah, so that is a future benefit when you have the chicken. Okay. So all assets actually have a value. So there is actually market price, which is what the market dictates, and also potential of the asset. So you cannot confuse that the sales price is the value. No, it doesn't work that way. Sales price is just a sales price. Value is how people perceive it. And value is typically derived from the usage and recognition of its price. So let's say for a bottle of water, at 7-Eleven, it can be $2. At a mama shop, it can be $1.50. At a wholesaler, it's 80 cents. So $2, $1.50, and 80 cents is just the sale price. In Singapore, you think that 80 cents is very expensive. But if bring that bottle to a desert, how much will you pay for it? Yeah, so that is something that you have to think about. So it's actually the usage that is very important and not the sale price. Sale price is just sale price, how much I'm willing to pay for it. So these are common metrics used when we do a lot of value investing. So the first one is actually a price to book ratio. So for this is actually what is the current price versus what is the book value, which is actually the asset valuation. It will be complicated if I expand it further, but just take it as the value that is recognized by accounting. So that is price to book. So the lower it is, the better, because let's say if it's 0.5, I'm just paying 50 cents for $1 value. That is good to me, but that is not good to the others. So the second matrix is PE, price to earnings, which is basically how much is the current price versus the earnings. So of course, the bigger the earning, the better. So for PE is actually a ratio, so we want it to be as low as possible also. Okay, for debt to equity is actually how much debt a company have versus equity, which is the amount of equity there is. The lower the debt, the better. The lower the equity, the better. The higher the equity, the better, because this actually brings down the overall debt for each equity. So if debt is very low, the company definitely can survive any issues like current COVID-19. And the fourth metric is PEG, which is the price or earnings to growth. This is actually a matrix to understand whether the company is growing or not. And finally, the FCF, the free cash flow, whereby we understand how much cash flow does a company have. Okay, we can have a company that has a lot of asset value, but it does not have cash flow. What can it happen to it? People can bankrupt it, which is very often like let's say for example during the great financial crisis.
Ethan, are you talking about Singapore Airlines?
Uh, you can think of it that way. Okay, but free cash flow is extremely important. So if we have very little, it's just like we have a lot of assets, but it does not have cash. So when it doesn't have cash, it cannot pay their debtors. Then it might result in assets being marked or sold at a very low cost, which is the sale price compared to its asset. Then it is also not good. Which means even if I get a discount of 0.5, let's say the price to book, but if the asset is selling at 0.2%, which means 20% of its valuation, then isn't it even worse? So you will lose money also if there is no FCF, like free cash flow. Okay, so now we move on to what is growth investing. Growth investing is more about trying to understand the growth of the business, or the business actually positioning itself to have explosive growth, to grab a big market share. So it is unlikely to be profitable currently. So we cannot use whatever value investing matrix that we use to look at growth companies. So for example, during Amazon in the early stage, it is really a cash burning company. That there is revenue, but whatever revenue is used to do more marketing and everything. It's just to acquire assets, do more marketing. So you can look at the expenses actually much outweigh the revenue that it's getting. So there are also potential companies like currently we have Grab or C Limited, because they are diversifying, they're investing a lot outside, trying to grow their market share, trying to increase the asset valuation also. So
C Limited is the one that has the Shopee app and G Arena, and also they call it C Pay or Shopee Pay.
Yes, correct. So these are actually they are trying to grab a lot of market share. You can see Shopee giving a lot of 10%, 15% discount or coins in terms of it. So they are really bleeding a lot. If you look at it in that sense. Yeah. So these are common metrics used. The historical earnings growth, which is based on his history, like how much is it growing their revenue, and also their projected earnings growth, which at current point they try to project as much of their growth as possible. Then also the profit margins. Profit margin is more about, okay, let's say I get an item and everything. Let's say the operating expenses or the amount of money I need to produce that product may be $1. But if I sell at 150, my profit margin is 50 cent, which is 50 cent over $1, at least 50%. So if the profit margin is high, definitely it can aim to grow very fast. And the fourth matrix is return on equity, ROE. This one I think we may need people like Sir Jing or David to explain further. Yeah, because I'm not very familiar with this. And lastly, the stock performance basically is about the historical stock, how much.
For growth investing, I don't look at ROE there because it's always negative one.
How much negative is also important.
Usually around negative 100%.
Yeah, 100% is okay. You cannot have negative 10,000%. That one is a bit crazy. You are spending money like crazy already. That could be an issue also.
The CEO not so dumb.
Yeah, hopefully. Okay, so how to make sense of both? So you have to understand that the matrix to judge both investing is different. So for value, it's a lot about what is asset based on. But for growth, it's really about future potential earnings, their future market share, how much more can they grab. So there is actually an argument on which is more superior. So some people say value investing is superior, some say growth investing is superior. So, but down here, we believe that we don't have to argue. What matters is, can we make money or not? Can it make a return on investment or not? That is the most important thing. So doesn't matter whether it's in value or doesn't matter whether it's growth investing. As long as it make money now, definitely it is good. Yeah. Okay. So now we have come to the bonus section. We have Jing, ex-Motley full staff, and he's extremely experienced in investing in the US market. He started his journey like at least 18 years old. So let's welcome Jing. Yeah, Jing.
Hello, everybody. Thanks, guys, for having me. Looking forward to the chat.
Okay. So Jing, before we start with the heavy stuff, I think maybe we start with something, right? So
Yep.
we would like to maybe understand what is your typical working day now as a co-founder of Compounder Fund. What are you actually busy with nowadays?
Sure. So Compounder Fund is just it's just an investment fund that invests in stocks. My typical working day, there's a lot of reading involved, a lot of writing. So I read all kinds of stuff. I particularly like to read Twitter threads nowadays. Threads as in THREADS. Like not being threatened by somebody, but like threads. Because like I think there are really smart people on Twitter nowadays, and you can get really condensed pieces of high quality information very quickly. So I read that a lot. I try to read very widely different kinds of topics. So I also like to read about what's going on in the world of like technology and science. And then I also I try to get some exercise in, try to sleep as early as I can, though I'm kind of failing on that in recent times. And then I also
working hours.
my typical so that's the thing, right? Like it's hard to define because I like in my leisure time I might be reading a book on economics. So is that work or is that leisure? It's hard to draw a line. Yeah. So I think in my case I've been very fortunate to have been able to be in a role where I'm truly passionate about. So I don't really see a clear distinction between like work and life. Yeah. So I don't measure my working hours. A lot of the things I do in my free time also happens to bleed into like things that I do at work as well. Yeah.
But the market hours are usually until midnight, past midnight, right?
Yeah, correct. So for my fund, we invest all over the world. So we have stocks in the US, Australia, Hong Kong, and Norway. But we are very much long-term investors. So what we do is we try to analyze businesses, and because of that, there is no real need to be keeping up with stock prices over the night. So I've never I've never ever had the experience of having to stay up to like 2-3 a.m. just because I'm watching stock prices. Yeah, so it's really just about understanding businesses for the long run and buying their shares for the long run. And yeah, so there's no need to stay up late to watch stock prices.
Okay, so am I right to say that there's two categories, right? There's traders, there's investors. So am I right to say that you gravitate heavily towards investing already?
Yeah, yes, correct. But I think I will also say that it is not because that is like the correct way to invest or that's the best way to invest. I think that there are many ways to make money in the financial markets. Every one of us need to be aware of what we are good at, what we don't know, what we know, and act accordingly. So in my case, I know that I have no ability to predict short-term financial market movements. I have no ability to predict things like interest rates and so on. No ability to predict commodity prices. So I stick to what I know very well, which is stocks, and also stick to long-term investing in stocks.
Okay. So coming to the previous topic that we are talking about, so what is your thoughts on growth and value investing? So which do you actually subscribe to? Have you done or you do both? Yeah.
So I think that the words value and growth investing are so overused today that they have actually lost a lot of meaning. I think that value investing, I think that ultimately there shouldn't be labels. Everything should be just investing. Because what we are really trying to do is to buy a financial asset, which are stocks, for less than what they are truly worth. Now, I think the labels come because different people have different methods for thinking about the true value of businesses. So I tend to view them more as just toolkits rather than styles of investing. And so, for example, if you use value investing in the way that you just described, then you'll be looking at companies that typically have most of their value in physical hard assets, right? And so to analyze such companies, you need the appropriate set of tools, which would be like looking at, say, the balance sheet and determining what types of assets it has and whether or not the values that are reflected in the balance sheet are accurate descriptions of the value of these assets. But on the other hand, if I'm looking at like company that is still young, that's still trying to grow, then if you look at its balance sheet, you wouldn't be able to find any value at all. And so you need to use a different toolkit to think about the where the value of this business can be found. So often, I think they are found in areas like the management's ability to innovate, ability to execute, the types of market that is operating in. Is it like is it like a fad, or is it a market where there are actual long-term secular growth trends that are powering it? So I think like yeah. So in my case, people also sometimes ask me like, what kind of investor am I? My response is always that, oh, I'm just a business-focused investor. So I look at businesses, I invest in businesses. Whether or not it's a value or growth, I don't think along those traditional lines. To me, they're just different ways of looking at companies.
Uh, yeah,
Were there any recent IPOs that you bought into?
Again, sorry.
Any recent IPOs that you subscribed to?
Recent IPOs, no. I think we have a few companies in the fund. Also, by the way, just before I forget, this is like a disclaimer. So whatever I say here today should not be taken to be investment or financial advice, and whatever I say is also not meant to be an offer or recommendation of any security or any financial product. So I just need to be very clear about that for everybody that's listening in. So we have bought some companies in our fund today that are relatively new to the market. Maybe they've IPO'd over the past, say, 2 or 3 years. So an example would be like DocuSign, Okta. These are US listed companies. Yeah. But like if you're saying recent ones, then no. Yeah.
So okay, let's move on to the second part. So can you actually elaborate a bit more on why did you set up the compounder fund? So what is the objective of this?
Sure.
Yeah.
So the reason why I set up Compounder Fund is really Compounder Fund's mission is to grow your wealth and enrich society. It kind of combines both two things that I'm very passionate about, which is investing and helping people. So Compounder Fund so my co-founder's name is Jeremy. To Jeremy and myself, we see Compounder Fund as more than just a business. It's a way for us to build a vehicle for people to grow their wealth, and at the same time, we can enrich society. So what do I mean by enriching society, right? So there are a few key things that we want to accomplish for the fund. The first is that eventually we want to open up the fund to all investors in Singapore. Right now, we can only serve accredited investors because of regulations, and we are very strict about that. But eventually, as we grow, we hope that we can gain the requisite experience and the requisite size of the fund, and set up a vehicle that can accept all investors in Singapore. Which is not easy to do because the costs involved are really high, much higher than if you're running an accredited investor-only fund, and the operational requirements are also much higher. But Jeremy and myself, we think that is the right thing to do, and that's something that we really want to achieve. And the second thing is we want to also have the fund be a platform for investor education. So what we have been doing is we have been running the fund very transparently. Investors in the fund can go to the fund's website and see all the fund's holdings, and also we've also been publishing the investment thesis for the holdings in our fund. We've published, I think, 9 theses so far, and we'll continue to do so over time. We have 40 companies in the portfolio today, so there'll be at least 40 of these theses that we publish on the website over time. And the idea is that we want the fund to be a source for investor education. And by running it very transparently, then that's the way we can achieve that particular aim for the fund. We also want the fund to We also want to charge fair fees that can benefit investors. So, and we hope that by doing that, by leading to way of example, we can raise awareness for fairer fee structures in the financial services industry, and potentially help to spur change in our space. So in our case, our fee structure is such that our management and performance fee will actually decline as assets under management grow, and we will earn most of our revenue from running the fund will actually come from the performance component, meaning that we will only be able to make money if our investors can actually earn a decent rate of return over the long run. Yeah, and the last thing is that by setting up a fund, Jeremy and myself, we become a business owner, and that gives us the opportunity to be able to earn more financial resources for ourselves. But by earning more resources for ourselves, then we have the ability to channel more resources to help the needy in society. So for Jeremy and myself, we have pledged to give at least 10% of our personal profits from running the fund every year to charities of our choice. So I think the four key pillars for the mission of Compounder Fund can actually kind of like showcase why Jeremy and myself decided to set up the fund.
Okay, yeah. So that's really, really very noble of you, because
No.
yeah,
It's
no,
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 don't say
it's true,
that.
because if you look at it, that there's actually quite we call it parallel between the insurance industry and the fund industry. But both are actually currently that there's a lot of mistrust in people who manage funds, and mistrust in people who do insurance planning. But it's slowly changing. So that's why I think it's very noble that actually you set the correct stand, you set the correct the way to move forward. So
Thank you.
talking about the compounder fund, right? Yeah. So we feel that probably there are a lot of mistakes that people make in stock investing. So
Mm-hmm.
from your experience, what are actually the very, very common mistakes that people make in stock investing? Maybe you can name about top 4 or 5 that you keep hearing. Yeah.
Sure. So just a few that are off the top of my mind, right? So I think the first is people not being aware of market history. And I think that creates a lot of unnecessary stress. So for example, like say when the stock market falls by a certain amount in a day, people start panicking and thinking that, this is like the end of the world or something really troublesome is on the horizon. But if you look back over the very long run of history, we will realize that stock prices move up and down. It is what stock prices do. It is what the market does. Even for the best companies in the world, their stock prices have also been extremely volatile. For example, if we look at say a company like Monster Beverage, which makes energy drinks in the US, no, it's not a holding of my fund, but I think it's amazing because from 1995 to 2015, I think the stock was up by 100. I think it was up by 10,000 times or 100,000 times in value. I can't remember the exact number, but it's just a ridiculously large number. Where if you invested like say $1,000 or $10,000, you'll be a millionaire many times over. But over that period of time, the stock actually declined by 50% from peak to trough at least 4 times, right? And I think there were 2 occasions when the stock price actually declined by 80% from peak to trough. And I think this is a perfect example, of like showing how that volatility is a very common thing in the market. And I think a lot of investors do not appreciate that. And then when stock prices decline, then that gives them creates a lot of unnecessary stress on their part. So that's one mistake. I think another mistake is often confusing the economy with the market. And I think that the current COVID-19 crisis has generated a lot of discussion on those fronts, especially like if you look at the US stock market, the S&P 500 and the Nasdaq are either at or near all-time highs, and that is during a situation where there's severe unemployment in the US, the virus COVID-19 is still rampant there, and all kinds of troubles. But the interesting thing is that if you actually break down the performance of the companies within the S&P 500 or the Nasdaq, we'll see that it's the large companies and the ones that are growing that have done very well. And people often, think that the market is the economy, but it's often not the case. And I thought, and there's a classic example that I really like, and it is that so I've seen this number before. So I think it's there's this number that from the 1990s to like 2013 or 2014 or 2012 thereabouts, the China's GDP actually grew by I think somewhere around 10% per year compounded, right? Or it could be even higher than that. But its stock market actually declined by 2% per year over the same time frame, right? So the GDP is growing at a tremendous pace, but the stock market actually shrank in value. And I think it's because because the market is often only a small portion of the economy, and people don't realize that. Like, and also we have to realize that the economy is, or rather, if you measure the economy by GDP, it's only a measurement of sales. But within sales, if a company isn't run well, if a company is beholden to, or rather, if a company has to serve not just shareholders but also like the government, like in the case of China, then you can end up with a lot of revenue, which is the GDP of the company, but very little profits. And I think that also affects stock prices. So what I'm trying to say here is that the second mistake, don't think about the stocks as the economy. They can be very different things. So that's the second common mistake that I think that I've seen committed by people. And I think the third mistake is overestimating the knowledge that they have. And I think this is also very apparent, I think, in especially with people who have very successful careers. So often when we are very successful in one area in life, we as collectively as people, we tend to think that our success or our knowledge in one area can be easily translated into another. And so what happens is, if like say you're a very successful doctor or a very successful engineer, right, and or lawyer, and you think that just because I've been successful in one field, I'll be able to invest really well, and then they go out there and try to invest in the market. Sometimes it turns out well, sometimes it doesn't, right? And I think a great example is I also saw this statistic before. So there's this Mensa club, right? MENSA, which is like the club that accepts people with like very high IQs. So I think like you must be in the top 2 percentile or top 1 percentile of the IQ range of the general population before you can be accepted into Mensa. So in the US, there was this the Mensa club had an investment like a club within Mensa, and their performance was just horrible, right? Like during the 1990s, they got their performance basically got smashed because they were way too smart for their own good. They thought that they could time the market. They thought that they could read, all these various different economic signals and come out with valuable signs of when to move in and out of the financial markets. And so they did all of that. They tried very exotic types of investment instruments and so on. But their results were just horrendous. I can't remember off the top of my head. But trust me when I say that it is horrendous, especially when put into context, that in the 1990s, the US market had a really strong performance, but the Mensa Club's investment team had nowhere near that level of performance. Yeah. So I think those three are some of the more common investment mistakes that I've seen people make.
Okay, so since these are the common mistakes people make, so we would like to understand like how do you cope with all these emotions when you're investing? Because you can see that some people look at the stock price, it's up 10%, or it's down 50%. The emotions start to show on their face. They be like, hey, I'm so worried. Hey, what happened? Hey, why the stock market drop until like this? So how do you, what are the advice that you can give to all these people actually?
So in my earlier days, so I started my career in the investment industry with the Motley Fool Singapore. I was there from January 2013 to October 2019. In my earlier days at the company, I was very optimistic that this investment, the right emotional behaviors can be taught. But over time, I think sadly come to a leaning more heavily toward the idea that I think there are just some people who are wired better to be able to control their emotions when it comes to the financial markets, and there are some people that are just not wired to be able to control their emotions. So I think for the first group, the people who are wired to do so, I don't think there's any advice that's needed to do. I guess they just intuitively understand that, hey, prices move up and down, and they're able to handle it with equanimity, and they won't panic when things move up and down. But I think for the second group, there may be a few things that can be done. So I think an important thing is to keep like an investment journal before you make any investment decision. Write some of your thoughts down, right? And then when prices move against you, then you can take a look at the journal to see, oh, what is the reason for that? Is my investment thesis still true? If it is, then that can perhaps give them more confidence to be able to hold on. But beyond that, I don't have. I don't think that's probably the best idea that I have. I don't have much more that I can offer in terms of
Do you
helping.
use a physical journal or do you use a digital one?
Mine is digital. Yeah.
What's the website?
Sorry, website.
What's
You
the
mean?
app?
Oh no, I don't have an app. I just like write Google Docs down. Yeah.
Oh, right.
Yeah. But because I'm also publishing like my investment thesis over time through the fund's website. So that also serves as like a journal of sorts as well. Yeah.
Okay, I think you miss out one very important thing.
Mm-hmm.
Yeah, let's hope your fund comes out so for the retail investors, so for people who cannot handle it, they can just put it with you, right?
No. Thanks for that comment. No, but I think it is still difficult because if people invest in a fund, they are still very susceptible to emotionally driven mistakes. I give you a classic example, right? So Peter Lynch is one of the best fund managers I think the world has seen. He's an idol of mine as well. From 1977 to 1990, Peter Lynch's fund delivered an annualized return of 29%. Right, but I think the average investor in his fund earned only a single-digit percentage return. I believe it was 7%. So 7% versus 29%, huge difference there, right? And the reason is because his investors would bail out of the fund whenever it declined, and they will only bring back in after the fund had started rising. So in effect, right, what they were doing is to buy high and sell low, right? And this happened even with one of the best, if not the best investor of all time. So I think just having a good fund manager is not the solution. The solution should really be to understand market history, to understand that volatility is part of the game, and somehow have some mechanisms in place to keep emotions in check. Yeah, I think that is way more important than just finding a good fund manager and investing with the fund manager.
So okay, this is quite a personal question. So
Mm-hmm.
so let's say if you have to introduce someone,
Mm-hmm.
or maybe some company that you know that can actually help people to cope with their emotions. Do you
Mm-hmm.
have any current companies or current people that you think that can actually do it, as in to
Mm-hmm.
really guide people with their emotions? So who are
Mm-hmm.
the group of people that you think that they should look for in this case?
I don't know any organization or individual who does something like that. But I have a book that I think is very useful for people. Two books actually that I think is useful for people to read to understand their behavioral biases and why these emotions occur. And hopefully the knowledge can help in some ways to to help them better control their emotions. So one is this book called Thinking Fast and Slow by this psychologist named Daniel Kahneman, who won a Nobel Prize for economics actually for his work in behavioral psychology and behavioral economics. So Thinking Fast and Slow talks about two thinking systems that our brain has. System one is like the very reactive system. It's part of like how our caveman ancestors would use to react to life or death situations. Uh, System two is something that is a bit more modern. It's like our logical thinking part of the brain. Yeah. So it's a very interesting book that talks about these two systems and how they interact and how they sometimes are at odds with each other. Yeah. Then the other book is Your Money and Your Brain, which also talks about behavioral psychology and behavioral economics, but links it more closer to the investing itself. So it's written by this financial journalist named Jason Zweig. Yeah, so it has a lot of good examples of how our minds often play tricks on us. Yeah. So for example, right, one of the things we as humans tend to do is that we tend to look for patterns all the time in whatever we see. And so what happens is in the financial markets, prices move up and down, right? So we tend to start looking for patterns. So like after reading that, right, many years ago, then, I made a conscious decision not to look at stock prices too much and to also, as much as possible, never ascribe reasons for short-term price movements unless there's a very, very clear-cut reason why the stock price of a certain company has moved in a particular way. Yeah. So that's an example of like how the book has helped me.
Yeah, so I think we have discussed quite a bit. So Jimmy, maybe we have any questions currently?
Okay, right. Okay, thanks Ethan, David, and Jing for the fireside chat and the bonus section. We hope you find it valuable with regards to investing. So we'll now go for the Q&A section. So if you have any questions with regards to investing, now is the time to post your questions as we are now addressing them. Right. So Ethan, any questions from the watch party you shared?
No, currently. No, currently.
Don't have. Okay. So my side, no questions. Just a comment on growth investing. Yeah. So you just comment that growth investing is like you get to the top of an oak tree by sitting on an aircon.
Oh, that's a great comment.
Interesting.
Yeah, wonderful comments.
I think they are not just sitting on top of an acorn, which is not. It must have a very good butler. It must have a very good resources given to it to grow that's what I think. So we call it growth, what? So they must have a very good butler, like the management, resources, which is the equity, the people inside it that actually supports the company, because I think we can all agree on big companies require a very good leader, good management team, and even very good operations team to make the company work. Yeah. So I think it's more than that, but that's the general idea at least. Yeah. What about David? What do you think?
Actually, I'm curious about the compounder fund. How often do you buy in?
What do you mean? Sorry, what do you mean by buy?
As in to do transactions.
We are very long term oriented. So we are targeting. So we're still our fund is still very young. We only started trading in the middle of July. We are targeting an annual portfolio turnover ratio of 20%, which equates to an average holding period of 5 years or more. So we make very little. We are intending to make very little trades.
So does it mean that you buy in slowly, or do you buy in like 80% or 90% or 100% of your fund value within the last 2 months?
Yeah, so my Jeremy and myself, our personal investing belief, which is reflected in the fund's operation as well, is that it makes sense to be nearly fully invested at all times, because we don't have any ability to tell when a bear market will happen. So because of this, we want to be nearly fully invested at all times. Partly also because statistics have shown that if you miss even just a small number of the market's best days, your return can significantly decline. And the difference between, like, say, missing the 20, let's say over a period of 30 or 40 years, or to 20 or 30 years, if you miss just 25 of the market's best days, or even 10 of the market's best days, your return can actually fall from, say, 8 or 9% compounded annual return. It can fall all the way to near zero. And so it is very drastic when you actually miss the market's best days. And so our thinking is that if we cannot predict when the market will decline, then we should be invested in the market. Yeah. So we actually kind of deployed the capital very quickly after we had launched the fund. Yeah.
Does it mean that you cannot buy any more until you get fresh funds?
It does not mean so. We can actually make changes to the portfolio whenever we want. So, like for example, if we realized that we had made a tremendous mistake, or like a company that we bought, we realized that it's a complete fraud, then we would we would have to make changes to the portfolio. Yeah. Or if some very drastic event happened, for example, like if in some gathering of chief executive officers in the US, and then there's some horrendous tragedy that happens, and happens that a lot of my company's leaders are in that happen to be in that meeting, then I will have some serious homework to do to think about what to do next. But there's no policy that says that I cannot make any changes to the portfolio. Yeah.
So, for example, in August, how many changes have you made?
None at all. Yeah. We finished investing on the end of July, and from then to today, we have not made a single trade.
In that sense, does it mean that you don't have to work much?
We don't have to work much. So a lot of the things we do is actually we do a lot of reading, a lot of research, a lot of thinking. So sometimes the thinking may seem like we're not doing much work, but the idea is that we are always thinking about are there better companies out there to be that can form the portfolio. Yeah. Because every decision not to sell is also an active decision that we're making. Yeah. So yes, a lot of the work would seem very passive in terms of us just having the time and space to think.
What's the minimum tranche for AI investors?
I think these questions I think it would be best if I don't publicly discuss because there are like regulations involved. Yeah.
Okay.
So, Jimmy, I think due to lack of time, we may need to wrap this up very soon already.
Okay, sure. Right. So, with the interest of time, we are going to end this episode. So, nevertheless, thank you for tuning in to our Facebook Live. If you have any questions still with regards to investing, you can still post your questions in the comment section, and we will address them during the next episode. So, as you can see in this final slide, there's this QR code whereby if you scan this QR code, you have access to our landing page where you can check us out on Facebook, website, YouTube, and Telegram channel. Okay, if you join us on our Telegram channel, you'll be able to see the list of resale insurance policies that we have. So if you want to find out more about all these resale insurance policies, do contact us via Telegram channel and we will get back to you. Right. So speaking of the next episode, join us next Friday, 5 p.m. for JEDi episode 18 on investments part 7. If you like our content and be notified for future episodes, do like our page on Facebook and share this Facebook Live. We will see ya next Friday, and
May the
the finances be with you.
Okay.
Okay, goodbye.
Thank you,
Thanks, everyone.
for your attendance
Thanks, Jing.
today.
No, my pleasure. Thank you.